Welcome to the Bullion Signal Podcast, the channel where we look at the big picture, the macroeconomic trends, and what they mean for those of you trying to protect and grow your wealth, especially with assets like gold and silver. Now, have you ever felt like you're just getting hit with a tidal wave of bad news every day? A spike in inflation here, a major bank getting bailed out there, talk of a new crisis just around the corner. It can feel completely disconnected, totally random. But what if it isn't? What if all these chaotic events are actually just pieces of a much larger puzzle? What if it's all part of a single, predictable mechanism, a historical pattern that has repeated itself time and time again, and is playing out right now, in our lifetimes? Today we're diving deep into a fascinating analysis that suggests exactly that. We're going to act as detectives and uncover this pattern. All right, every good investigation starts with a clue. And our first clue is this number right here, $307 trillion. It's almost impossible to even comprehend a number that big, right? Well, according to the Institute of International Finance, that is the staggering amount of total debt in the global economy. But look, the number itself, as shocking as it is, isn't the real story. The real story is its relationship to everything else. This debt pile represents 384% of global GDP. Let that sink in. For every dollar of economic output in the world, there are nearly $4 of debt. And to really put that into perspective, think about this. Back in the year 2000, that ratio was only 62%. So in just over 2 decades, we have levered up the entire global system in a way that is historically unprecedented. It's a mountain of obligations built on a molehill of actual production. And that brings us right to the heart of our investigation today. This is the central question we have to ask ourselves. Is this massive number just something we can manage? Can we just, grow our way out of it like we're always told? Or is it something more ominous? Is it a critical symptom, a flashing red light on the dashboard of the global economy, signaling that we're in the final dangerous stage of a cycle that has played out many times before? The source material we're examining today makes a very strong case that it's the latter. It argues this isn't just a big number, it's a diagnosis. Now, to solve a mystery this big, you can't just guess. You need a framework. You need a reliable tool that can help you see the pattern through all the noise in the daily headlines. For our investigation, that tool comes from the work of an economist named Hyman Minsky. His theory on financial instability isn't just some abstract academic exercise. It gives us a very clear 4-stage pattern. It's a lens that we can use to look at our current situation, but just as importantly, we can take this lens and look back at past crises to see if the pattern holds true. It's about testing the theory against reality. The core concept at the heart of all this is something called the Minsky Moment. You may have heard the term. It's that precise, terrifying point when a market that is drowning in debt, completely over-leveraged, finally collapses under its own weight. It's the moment the house of cards comes down. But here is the absolutely crucial part of this definition, according to the source material. A Minsky moment is not a random event. It's not bad luck. It isn't some black swan that nobody could see coming. It's presented as the mathematically inevitable conclusion to a predictable pattern that was set in motion years, sometimes decades before. It's the final logical step in a sequence. So let's break down this tool, this 4-stage cycle. Stage 1 is called the new regime. This is what happens after the last crisis burns out. A new monetary system, new rules are established. Think Bretton Woods after World War II. Because everyone just got burned, credit starts to expand again, but very cautiously. Stage 2 is where things get interesting. It's the speculative mania. The collective memory of the last crisis fades, and caution is thrown to the wind. Debt absolutely explodes. Asset prices, stocks, real estate, you name it, they detach from any sense of fundamental value. And crucially, borrowing shifts from productive things, like building a factory, to pure speculation. This is what Minsky called the Ponzi phase, when you're borrowing new money just to pay the interest on your old debt. Then comes stage 3, the trigger. It can be anything really, a bank failure, a war, a political event, but it causes a sudden, violent shift in psychology. The illusion is shattered. Panic selling begins, liquidity dries up, and everyone runs for the exits at once. And that forces the hand of the authorities, who usually step in with bailouts. Which brings us to stage 4, the outcome. Here there are only 2 doors. Door number 1, the system collapses into a deflationary depression. Door number 2, the system is saved by massive currency debasement. In other words, inflation. Okay, so that's the theory. But a theory is only as good as its ability to predict or explain reality, right? It's time to put our detective's tool to the test. Let's apply this 4-stage pattern to 3 major financial crises from the last century. We need to see if history rhymes, if this pattern actually shows up in the real world. This is how we'll build our confidence in the framework before we apply it to today. Our first case study is a classic, one that people who own gold and silver know very well: the Weimar Republic in post-World War I Germany. After the war, the Treaty of Versailles burdened the new German government with crippling reparations debt, a debt so large it was impossible to ever repay through taxes alone. From the very beginning, they were trapped in a financial corner with no easy way out. And when you lay Minsky's framework over these events, it fits like a glove. It's almost a perfect illustration. Stage 1, the new regime. The Weimar Republic is established, a new government born from the ashes of the German Empire. Stage 2, the speculative mania. This was a mania of the state itself. The central bank, the Reichsbank, just turned on the printing presses to pay its debts. Stage 3, the trigger. It wasn't a single event, but a political reality. They simply could not tax their people enough or cut spending enough to close the gap. The only option left was the printing press. And the outcome, stage 4, one of the most infamous cases of hyperinflation in human history. The currency was utterly destroyed, wiping out the savings of an entire generation. The pattern holds. All right, let's move forward in time to our second case study, the United States in the 1970s. After World War II, the new regime was the Bretton Woods system. This made the US dollar the world's reserve currency, and importantly, it was convertible to gold at a fixed price. It provided an anchor of stability. But then came the 1960s, with massive spending on both the Vietnam War and huge domestic social programs. The U.S. started printing more dollars than it had gold to back them, putting immense pressure on the system. And once again, the pattern maps perfectly. Stage 1, the Bretton Woods gold standard was the new regime. Stage 2, the speculative mania was the massive expansion of the money supply to pay for guns and butter, as they called it. The U.S. was writing checks it couldn't cash in gold. Stage 3, the trigger, was the famous Nixon shock in August of 1971, when President Nixon went on television and unilaterally severed the dollar's last link to gold. He closed the gold window. And stage 4, the outcome? A decade of painful runaway inflation combined with a stagnant economy. They called it stagflation. And it was only brought to an end when Fed Chair Paul Volcker jacked up interest rates to 20%, inducing a brutal recession to reset the system. And now, for our third and final historical case study, one that's still fresh in the memory of so many of us, the 2008 global financial crisis. You know, it's fascinating because the seeds of this crisis were planted in the response to the last one. After the dot-com bubble burst in 2000, the Federal Reserve, under Alan Greenspan, slashed interest rates all the way down to just 1%. This flooded the financial system with incredibly cheap and easy money, and that set the stage for the absolute madness that was to come. Let's run the checklist one last time. Stage 1, the new regime, a world of ultra-low interest rates and easy credit. Check. Stage 2, the speculative mania, the U.S. housing bubble built on a mountain of toxic subprime mortgages and complex derivatives that nobody understood. Remember the ninja loans, no income, no job or assets? That was the mania. Check. Stage 3, the trigger. The shocking collapse of Lehman Brothers in September 2008, which froze global credit markets overnight. Check. And Stage 4, the outcome. The system was saved through unprecedented government bailouts of the banks, interest rates were slashed to zero, and a new policy was invented out of thin air, quantitative easing, or QE. which is really just a polite term for creating new currency to buy financial assets and prop up the system. So 3 for 3, the pattern holds perfectly. So we've tested our tool. We've seen this 4-stage pattern play out in Germany in the 20s, in the US in the 70s, and across the globe in 2008. 3 very different times, 3 different specific causes, but the same underlying pattern of debt, speculation, trigger, and outcome. The source material argues that having established this historical precedent, it's not just an option but our absolute duty to turn this detective's lens onto our own time. So the critical question now becomes, where are we in this cycle right now? And the source material we're analyzing doesn't mince words. It couldn't be more direct. The conclusion it draws is this, and I'm quoting, "The United States is not immune to the pattern. It is currently in the pattern." This is the key takeaway. This isn't just an interesting history lesson. The argument is that this is a live description of our present-day economic reality. We're not watching a documentary about a past crisis. We are characters in a crisis that is unfolding in real time. Okay, let's look at the evidence presented in the source for this bold claim. Let's run our current situation through the Minsky checklist. Stage 1, new regime. The post-2008 world became our new regime, a world of zero interest rate policy, or ZIRP, and seemingly endless quantitative easing. That became the new normal, so check. Stage 2, speculative mania. Where do we even begin? From meme stocks to cryptocurrencies with no utility going to the moon, to that $307 trillion global debt bomb we started with, I think we can safely say it's been the biggest speculative mania in all of human history. So, check. Stage 3, the trigger. The source argues the trigger has already happened. The fastest, most aggressive interest rate hikes in 40 years, which directly caused the cascade of bank failures in the spring of 2023. Silicon Valley Bank, Credit Suisse, and others. The first dominoes to fall. Check. Now, if you agree with this analysis, the conclusion is inescapable. The first 3 stages are already behind us. And this, right here, is the most important part of our entire investigation. If the first 3 stages of the cycle are already complete, then that means we are currently living in stage 4. We are in the outcome phase, right now. So what does that mean for us, for our savings, for our future? According to Minsky's model and the analysis of our source material, there are only 2 possible endings from here. There is no easy third option. Path 1 is a deflationary collapse. This is the Great Depression on steroids. Mass defaults on debt, widespread bank failures, the entire system just breaks. It's a sudden, sharp, and incredibly painful reset. Path 2 is the hyperinflationary reset. To avoid the pain of collapse, central banks simply print money on a scale that would make 2008 and 2020 look like a warm-up. They monetize the debt. The system is saved, but the currency is destroyed in the process. This path creates a massive, silent transfer of wealth from anyone who was responsible and saved money to those who are hopelessly in debt. So which path will be chosen? When faced with this impossible choice, the source argues that history gives us a very clear answer. Politicians and central bankers will always choose to inflate. Always. And the reason is simple. Political survival. A deflationary collapse is loud, it's messy, it's immediate. People are in the streets and governments fall. It's politically catastrophic. But inflation? Inflation is a quiet thief. It's a slow, creeping process that erodes your purchasing power over years. And best of all, from a politician's perspective, it can be blamed on corporations, on foreign wars, on supply chains, on anyone but them. It is always, always the path of least political resistance. And that leaves us right here with this final provocative thought from the analysis we've just walked through. The claim isn't that the Minsky moment is coming someday. It's that we are living through it right now, but in slow motion. The pattern is nearly complete, and we are in the final act. The final question it poses, and the one I want to leave with you to think about, is this. If this historical pattern is as reliable as it appears to be, if we are truly in stage 4 and the choice will be inflation, what do you think happens next? And more importantly, What are you going to do about it? That's all for this episode of the Bullion Signal Podcast. If you found this analysis valuable, if it made you think, then please do us a favor and hit that like button, subscribe to the channel, and share it with someone who needs to hear this message. Your support helps us continue to bring you this kind of in-depth content. Stay safe, stay informed, and we'll see you in the next one. Now for our disclaimer. The content discussed in this podcast is for informational and educational purposes only. It is not and should not be construed as financial or investment advice. You should always conduct your own research and consult with a professional financial advisor before making any investment decisions. You are solely responsible for the choices you make with your capital.